Hello everyone. Well, I hope you enjoyed your summer and made the most of vacations and family time. Just like that, we're in the full swing of my favorite time of year, the fall. And just like the seasons change, so do the markets. The last 2 years have felt like a roller coaster. Up, down, and then up and down again. While that may be unsettling, it's both normal and expected with where we are in the economic cycle. Remember that whether the market is down 20% or up 10%, we, in partnership with you, have prepared for this. As we look ahead, it's always important to keep focused on what you can control, the things that matter most to you, like your family, your occupation, and your recreational time. For more clarity and details on what to expect, take a couple minutes to view this video from our model manager, Seth Diener, where he reviews the recent changes in the portfolios and the strategies with the current economic cycle. Thank you for your continued confidence and trust, and we will be in touch.
Thanks, Joe, for the introduction. The year is 1970. The Beatles had just broken up, and Apollo 13 had taken flight towards the moon. It was the best of times and the worst of times. 1970 was also the last time the stock market started off the year as poorly as it did this year. Make no mistake, this year has been tough for investors. Our goal in this video is to provide you with some substance towards the recent market volatility, provide some context towards what to expect going forward, and provide you with insight as to where we see pockets of strength. So what happened? We hit a low point in June of this year, minus 25% in the market. More recently, in September, we retested those lows. To put that into perspective, during the start of COVID, we were down about 35%, and during the Great Recession in 2008 and 2009, the markets were down over 50%. So what caused the markets to slide? It had a few causes, but it was mainly due to rising interest rates and inflation. The interest rates, as the higher the interest rates go, the more expensive it is for consumers and businesses to spend money. The war in Ukraine and the fear of a recession has added to the volatility. So where do we go from here? When considering the business cycle, we just entered into a late cycle in August, which is followed by a recession cycle. Just like 1970, we have a case of good news and bad news. The bad news is that a recession cycle is the next part of the business cycle, and this should occur within the next 12 months. The good news is that we believe that recession is already priced into the stock market lows this year. If that is the case, as the recession unfolds, you will see these lows retested, but it should not slide much further. The best strategy for those that do not need the money in the next few years is always to stick with it. Stay invested through the bad weather, because beyond the recession, you will move into a recovery and back into a growth cycle before you know it. If you will recall, a large part of our investing philosophy is based on identifying the stage of the business cycle we are in and making adjustments to be in the areas that tend to outperform in that environment. What strategic moves have we made? During a late cycle and a recession cycle, we like to focus on large companies that pay good dividends. Generally, during these times, there are a lot of ups and a lot of downs, bulls fighting the bears. In a late cycle, we like to clip the coupon of a 3 to 4% dividend along the way. Get paid while you wait, because it takes on average 425 days to recover from a drop of 20+% like we experienced this year. Additionally, we like to be in sectors that historically outperformed in a late cycle. Our favorite sectors now are healthcare and consumer staples. What tactical opportunistic moves have we made? One we like a lot is a position in agriculture technology, including John Deere. Ukraine makes up nearly 30% of the global wheat exports. Due to the unfortunate continuing conflict in Ukraine, we've seen the supply of wheat drop, while the demand for it remains the same, and we expect that demand to continue into the future. U.S. farmers are projected to export more wheat to help satisfy the rising demand. Tractor fleets in the U.S. are aging and are due for newer, more efficient upgrades. John Deere is a great example of a company that is positioned to benefit. This is just one example of the unique opportunities we look to identify and take advantage of in this stage of the business cycle. These sorts of markets are very familiar to us and can be completely unnerving to investors, especially newly retired investors. Each time you go through this, it will be tough, and understand that you will go through this many more times in your life. These sorts of bad markets occur every 6 years or so. We want to make sure that we keep you informed along the way. That's very important to us, so that we can help you go live your best life while we absorb the heartburn of the market while still focusing on your goals. Thank you so much for the trust you place in us to manage your hard-earned savings and goals. And as always, stay strong, stay smart. Until next time.